Hello, Violin Society of America. We're excited to be here. I am Alan Friedman. You are?
Daniel Jobe.
We are from the CPA firm of Freidman, Kannenberg and Co. We're located in the northeast part of the United States. And we've had the honor of being asked to present to you some financial information that's applicable to your organization, your segment of music retailing, if you will. And we're pretty excited to do this today. We're in the midst of a pandemic.
Yeah, have you ever done a virtual presentation before?
I have not. We've done some live stuff.
Yeah, we really wish we could be with you all because the interaction when you're live is just so much better, as you guys know.
Yes.
But, you know, when we got the call and asked to present something, we didn't hesitate at all. We wanted to be a part. So We're glad to be here with you today.
It's awesome. We like to tell jokes and funny stories, but I don't think we're going to get a great reaction from you because we can't hear you.
We'll add the crowd sounds later.
Exactly. Anyways, we're pretty excited to do this. You know, I mentioned that we are all operating worldwide in a pandemic which has brought a lot of challenges, not only to our country but also throughout the world. And you know, there's been some economic fallout because of it. Certainly there's the health crisis. And so now more than ever, the financial lessons that you can learn as an owner of any business are becoming critically important. They were always important because of just the challenges of retailing and just operating in a very competitive marketplace. But now, you know, with the pandemic, we're under a new normal, and you have to find new ways of earning revenue and managing expenses.
It's like if they didn't have enough challenges going on, let's smack a big global one on.
Exactly.
And you know, Alan, what we found as we work with people is a lot of things about running a business are, number one, educating yourself, but number two, really trying to keep clarity of focus. And I find that the things that we've put in the presentation today, it's really about teaching you how to think. Because when you think about your business, you could run your business with emotion, and a lot of entrepreneurs like to do that, and we like that. But sometimes you have to step back and say, let's take the emotion out and strip it down and see what may be best for my business.
Some critical thinking.
Yeah, so critical thinking becomes really important.
Yeah, exactly. Well, Daniel, it's funny that you mentioned that. I actually, when you weren't looking, I inserted some slides to quiz your critical thinking.
Really?
Yeah.
So you want me to go next slide?
I would, yes.
Okay,
You have some surprises coming up.
Okay.
So there's a quiz I'd like to give you for 4 questions and see how you do. Okay?
I will not look at the answers.
All right. So my first question is, how do you get a giraffe into a refrigerator?
Okay, I'm thinking origami here.
Yeah.
You fold the thing up, put it in?
No. Okay, the answer is you open the door and you put them in. And now that might seem a little too logical. If the refrigerator is big enough, you can put a giraffe in. This is just an example of how we make problems tougher than they really are. Okay, I want you to start thinking, as they say, outside the box.
Okay,
there was another question.
Okay, another one.
Another one. This is a good one.
Okay, let's see.
Let's see if you learned a lesson. How do you get an elephant into a refrigerator?
Well, if I'm going to learn from the last mistake, we're going to open up the door and we're going to put the refrigerator in.
Not quite.
No?
Okay, that is sort of, but you have to take the giraffe out because don't forget the giraffe was sitting in the elevator. So the giraffe, this is an example how we don't learn from our mistakes and jump to faulty conclusions.
Right.
Okay.
Did you just say that the elephant was in an elevator or a refrigerator?
Did I say that? I meant a refrigerator.
Oh, okay. Okay. All right. Just making sure we didn't. Okay.
He could have been on an elevator.
Okay.
If the elevator was big enough.
I think I've learned now.
Okay. All right. So let's see. We got 2 more questions.
I have 2 more.
Yes. Okay.
Okay. Great. Let's
Number 3. There's a meeting of all the animals in the jungle. Which animal doesn't show up for the meeting?
I really don't know.
It's not the turtle.
No, I mean, would it be like a dog because it's not a jungle?
No, silly.
Okay.
No. Take a look. It's the elephant. He's still in the fridge.
Oh, the elephant's still in the fridge.
This is an example of how we tend to forget relevant facts when we're solving problems.
Got it.
All right, 4th question. The last one.
Oh, this is it. Good.
This is going to be easier, I think, for everybody except for you. Okay, you want to cross a river that's filled with alligators. How do you cross safely to the other side of the river?
okay, I'm going to put this together. We opened the door, let the thing in. We had to let the giraffe out to put the elephant in.
Right.
And then the elephant didn't go to the. So I'm going to guess it has something to do with a jungle meme.
You're on the right track.
You take a boat?
Close. You could actually, I believe, you could actually swim across because all the alligators are attending the jungle meeting. You were on the right
I
track.
knew it was something like that.
That's very good. And that's an example of how we can't seem to think outside the box.
It's important, isn't it?
So, as funny or not as you might find this test was actually given to a group of Anderson consultants a while ago. 90% of them got all the answers wrong, like you. The same test was given to a class of 6-year-old kids, of which 90% of them got at least 3 of the 4 answers correct.
Okay.
Which, the moral of the story is just because you're older doesn't make you smarter.
Got it.
That probably goes for both of us.
Got it.
So, Daniel put this slide in, and by the way, I reminded him that this is actually, I'm not kidding you, this is one of my 3 favorite movies. I love The Sixth Sense because I was lucky enough to see the movie without knowing anything about it. And it was, if you haven't seen it, it's a great movie. But I see stupid people walking around like they are smart.
But that's not you.
Yeah, no.
We're not talking about you. So now that we've taught you a little bit about critical thinking and how to think about things, we're going to get right into a couple things that we want to share with you today.
Right. And I will tell you, this is not rocket science.
No.
This is, it's logic, it's time-tested pearls of wisdom, if you will. We know after doing this for as many years as we have. I'm 64 years of age. I've been doing this for 40 years. Daniel is just turned 12, and so he's a little younger. Daniel's actually he looks very young, but he's in his 40s, and he's had 25 years almost of the same kind of experience. And so we know that we can fix a lot of the problems that you are facing and some of the silly things you've been doing by imparting timely, important information, which we're about to do.
Great.
Okay.
So here we go. So Alan, what is a typical music store's largest asset?
Inventory.
Inventory.
It's
the one that many owners get the most drawn into emotionally.
Yeah.
But yet it's your biggest financial investment.
It is.
I mean, it's hard to believe, but especially your salespeople, they forget that those are your hard-earned dollars sitting on the shelves.
Exactly.
And so as much as you want to be everything to everyone,
right.
Sometimes it's just not possible.
No, it's hard. And you know, what we often find with retailers who are over-inventoried, which we're probably describing 90% plus of the industry, just like you said, those are cash dollars in an illiquid form that we're desiring to turn back into a liquid form called cash plus some profit. So.
Yeah, we could talk about this topic for literally hours, but here's what we're going to do. We're going to take a couple minutes and give you the pitfalls. Here's the pitfalls we see with inventory. Number one, and the most important, is you don't monitor it.
Right.
What do we mean by that? If you're not counting your inventory, if you're not gauging your inventory to see how well it's producing, well, it can walk off. People can take it. Or you can have inventory that's not making you money. And just think about this, your inventory is like buying stock. If you bought a stock that was losing 5% every month, would you stay or would you get out?
Right.
So I know, and we know, Alan, we're going to talk about violin dealers because many times their inventory is a little different.
Yes.
We understand that.
Yes.
But we still want to talk about it. So non-inventory is one. Being told what you need to sell. I mean, think about the Violin Society of America.
Yeah.
They could come to you and say, customers walk in and say, well, do you have ukuleles? Do you have drums? I'd really like to have a cajon to play with my violin. Great musical instruments. Yeah. But is that really what you sell?
Right.
And then as we talked about the last one, no physical inventories. These are the top 3 things we see with inventory.
Right.
What do you think, Alan?
I would dare say that violin retailers may have it a little bit easier than other kinds of retailers, because if you think about it, at least in my mind as a guitar player, violins, there isn't a lot of obsolescence.
Correct.
Okay, so you don't have to worry about the things that some combo MI rock shops have to worry about, like samplers, drum machines, synthesizers, those kinds of things. The technology changes rapidly, and you're sitting on an overabundance of inventory that is literally becoming obsolete. You don't have that problem. But the problem that you do have with any retailer having too much inventory is that you could be choking cash flow.
Yeah. It's an issue of cash flow.
Yes.
What's your investments? So how do we fix these things? Well, our opinion is that you fix these things in the purchasing segment.
Right.
Because again, what do you always say, Alan? Buying inventory is nothing more than an educated guess.
Yes.
You buy it at the best price you can. You try to sell it as quickly as you can as well.
Right.
So how do we get around this? Alan, this is one of your favorite things. Can you go through this one?
So a lot of retailers get led down a path of thinking that, you know, if I get certain discounts, if I get flooring, or which may not be applicable to violin dealers, but there's certain incentives that manufacturers, your suppliers, will give you to induce you to buy a lot of product. And while that's sometimes okay, it's really important to never forget, really, our opinion that there are 4 main principles of buying inventory that you should never alter, you know, or steer away from. And those 4 things are just asking yourself these simple questions. When you're looking at any product, you should be asking yourself, can I sell it? Will I make a profit on it? How quickly can I sell it? And how quickly do I have to pay for it? When you answer those 4 questions, that will guide you on whether you should buy an item and how much of an item to buy if you decide you should buy it.
Yeah, great. Like I said, and Alan, you've got resources on the NAM website
Yes.
for purchasing inventory.
Yes.
Like hours of videos, right?
Right, exactly.
So, you know, we could direct you there for other resources.
It's NAM.org.
Yeah.
Really easy.
And get you there, and you can have more resources there. That's
Exactly.
good. This second topic is also one we like to talk about a lot, because now we're talking about turns and gross profit dollars, and that gets to a concept called GMRI.
When you were at Daniel has been on the front lines of financially running a large music retailing chain before he joined us. And Daniel, how important was it that you were monitoring turns and gross profit percent? And
Yeah, it was huge.
GMRI?
It was huge. And again,
And what did it tell you?
it tells you everything. I mean, it really tells you what makes money and what doesn't make money, and how you're doing with your investment, which is what we're concerned about here. And again, we know here. Let's get the elephant in the room. No pun from earlier intended.
Right.
But let's get it out of the way. And that is, we know you guys have high end stuff that is like, you have high end violins, you have high end bows, you have different things that people want, and you're going to have somebody come by sometime over the period. We get that. And you have to manage those things, and you have to look at those things, and you may have to allocate dollars from elsewhere in your store.
Right.
But in the end, you always have to have enough cash to pay your people and pay yourself.
Right.
So you have to kind of watch that, engage that. In inventory, when it's your largest investment, it's the one piece that you have besides your people, which is another important asset, to make money with.
That's right.
So we got to watch that.
There's certain metrics that we know that we live and breathe by in the management of inventory, and I'm just going to give you just a couple general overviews of what those metrics are. You really, when you buy product, you should be thinking in terms of selling it within a 30, 60, 90 to 120 day period. Now, some of you, I'm sure, can think of product that's been sitting in your store longer than that, maybe even in the years beyond just months. And while you can go a little longer than this, call it 30 to 120 day period, you really should only do that when you can assure yourself of higher profit margins. But if you're dealing with any product that has, lower profit margins, or, something, I'll give you a range of, let's say 20 to 35, 40%, somewhere's in that range, you really should be moving that product every 90 days, 120 days. If you can assure yourself you can get 40 to 50% margin, maybe you can go out 6 months. But I'm telling you, if you start thinking in terms of selling it within the course of the year, you're going to, unless you're flush with cash, you're going to have some cash flow problems by products sitting around that long.
Yeah, and we know for our people watching this right now, please don't stop the video, because we understand that your business plan is a little bit different with a high-end product.
Right.
But what's not different from other businesses is the cash flow concept.
That's right.
You got to have cash flow to pay the expenses.
That's right. I'll say one last little comment about this, that a lot of times dealers come up to us and say, gee, I have to carry this product. I know I won't sell it. It'll take me a year to sell it. How does that fit into the metrics that you're telling me to live and die by? And so if you have some product that you just have to carry to be a real violin shop, and it's going to take you a year, I would arguably tell you to reduce your advertising budget, because really you're carrying product really for the goodwill of being seen as a true violin shop to your customers. you're kind of ignoring the return on your inventory investment.
Right.
So.
If you could do a little bit of both, I think you're going to find success with the inventory.
Right.
But don't bury your head on the inventory. It's your largest asset, and it's why we wanted to lead off with it today.
Right.
All right, well, with the purchase of inventory, now usually we get some debt.
Yeah.
Doesn't this say we could relabel debt and put 2020 because everybody feels like they're just sitting on a
time bomb.
It's a weird year, isn't it?
It's been very strange.
But running a business is really, it's really about managing your debt.
Yeah.
And one of the things we say, Alan, all the time is that if somebody calls us and says, "Tell me some of the attributes of your greatest retailers," one of the top 5 items we say is most of them have little to no debt.
Right, exactly.
And as I worked with violin stores, and I always call them violin, we should call them orchestral to be correct, actually.
Mm-hmm.
A lot of them have low levels of debt, which is great.
Which is phenomenal.
Which is great. But even when you have to take debt on, if you're going to be in the rental business, another thing that we like in this industry. So if you're in the rental business, many times you have to take debt.
Right.
But what are some of the pitfalls, Alan, that comes with the debt?
Well, you know what? I'm going to tell you, I just want to say one quick little thing that you taught me, Daniel. You never know what's going to happen in any given year.
Yeah.
And just like you said, 2020 is a weird year. And when you look at it through that lens, going forward, it's going to be really important that you preserve cash flow in your business. Don't strip everything out. Keep some reserves of cash, because you just don't call it the rainy day fund.
Yeah.
With that being said, when debt is required, and we like debt, believe it or not, as long as it's managed, so you're not borrowing too much, it's not costing you too much, and it's appropriate for the levels of inventory that you have or other assets that you might be financing. What we like to say is, if you're going to borrow money, your banker should be guiding you on the vehicle, the correct financing vehicle to use to borrow that money for the specific asset that you're buying. Or said another way, if you're buying inventory, then the types of debt that you should be incurring to finance that inventory is either your trade debt from your vendors, or maybe short-term lines of credit where you can pull money, make a buy, sell the product, take the money plus profit, and pay off the debt. So it has this kind of effect on your line of credit.
Because you're trying to pay for it as you sell it.
That's
so it kind of
right.
holds you accountable to sell it.
Exactly.
For a period of time.
Exactly. And then there's other kinds of assets that you need more time to pay for because they won't turn to cash very quickly. We call those long-term assets. Dale.
Like your rental pool.
Your rental pool, exactly.
If you're
It
going to
comes in
buy
little pieces, right?
If you're going to buy a container of violins and throw them in your rental pool,
right.
You may need help with that if cash flows.
What do you see as the kind of loan that people are getting for their rental pools?
It really depends, and it really depends upon your rental program and your own cash needs. Some people get as little as 2 to 3 years. Other
Right.
people are stretching out 5, 6, 7 years.
Got it.
I think if you're getting like fractional strings
Right.
in that you're going to have for the next 10 years,
Yes.
you may need a 5 to 7 year loan to do that, especially if you're getting ready to beef up your pool or something like
Gotcha.
that.
Good point.
But having the right term, and many times, as simple as it sounds, bankers don't understand this because a banker, Alan, many times, as we know, they want to throw you in a line of credit.
Yeah, because they think that the rental pools are inventory.
You know why they want to throw you in a line of credit? It's pretty easy process for underwriting.
Right.
When you start getting terms of debt, they're like, well, how am I going to collateralize all these instruments
Exactly.
and stuff like that?
And what's the cash flows
Yeah.
look like, that kind of thing.
Yeah.
So,
Another pitfall, Alan, you mentioned this, a rainy day fund, no working capital.
right.
That's either because you don't have income or you have losses and
Right.
you just don't have money there,
Right.
or if the owners are stripping all the money out,
Right.
either because they can, they want to, they
Right.
need it, whatever.
Because we know violin shop owners are buying Maseratis and Ferraris
And yachts.
And yachts.
Very
Yes,
sophisticated.
we see a lot of
Very
violin
sophisticated. We do.
guys with yachts.
But here's the big one. We like to think of, when we think of debt, we like to think about, what about missing the opportunity?
Right.
Your number one, even with inventory, your number one consideration point always has to be the opportunity cost.
Right. Exactly.
Because like, what if somebody came to you, tomorrow and said, I've got this $100,000 pile of instruments that I'll sell you for $15,000.
Right.
If you can't get $15,000, you might have just missed out on an opportunity.
That's exactly right. That's exactly right. Or the opportunity, maybe even buy another violin shop.
Oh,
They're gonna-
yeah, that's a big one.
Right.
Who knows? So here's the solution to this. If you blow out excessive inventory, and again, this is kind of turning back to our first topic of inventory, it just kind of helps you cyclical. It'll create cash, which you can, what you do with that cash is up to you. You're gonna have to pay your expenses, pay your people, but then you can reduce debt. If you reduce the debt, there's a line on your profit and loss statement called interest expense.
Right.
People always sometimes say, what's the easiest way to reduce interest expense?
Reduce your debt.
Reduce your debt.
Right.
Again, this isn't rocket science, as we say. And then you can also increase profitability and cash flow. How do you increase profitability? Well, if you have cash, many times you can buy better.
Right.
And you can
Your margins get better.
margins get better. Right, and cash flow gets better.
Awesome.
So, and then we do the good cycle again. But again, too often we'll have other things that creep in, like COVID,
Right.
and then you got to deal with that and having cash flow. So being properly financed and making sure that you have a rainy day fund, we think is really important in a
Exactly.
business.
So there's a quick point I'd like to make about this slide. The owner is wearing too many hats. A lot of business owners think they're doing themselves a major favor by not only being that person that's running the store, buying the inventory, checking in the inventory, managing the cash flow, reconciling the checking account,
Fixing the toilet,
fixing the toilet.
because it broke.
That's right. Because you're saying, why? I can save a lot of money on a repair guy, I can save a lot of money on a bookkeeper, I can save a lot of money on a shipping, receiving person. So that's true, and that's all awesome until it's time for you to sell the business, or God forbid you get sick and the business still needs to run. If all of those functionalities of running your business rest with the owner, that means all the goodwill, the value of your business is resting with an owner. And if that owner gets hit by a bus, your store and your family are going to be behind the eight ball, because the store may not be able to run because all the knowledge base is with the owner. And if, God forbid, you were to pass away, and we're all going that path at some point, your family is going to have to deal with, selling a store, transitioning a store, and if all the value was with the owner, well, the value died with the owner. So we're big fans of making sure that you not so much do everything in the business, but manage the business and empower others. So,
Right.
So the pitfall here is if the owner is the only one that can do the sales, repair, accounting, rentals, ordering, bill, we see this all the time, then the value is with that owner. That's not a good thing, especially when it comes time to transition.
No, especially when you look at the second one, because how often are we
Right.
hearing burnout?
Yeah,
Burnout is a real thing.
that's right.
And it's one thing if you were in a job and you just said, okay, I can't do this anymore, I'm going to switch jobs. But when you've invested all of your cash into your inventory and your people, and you get burned out, what are you going to do?
Exactly.
So it's about pacing yourself. And Alan, I would say that there's seasons where you may do a lot of these things, like say you're building the business or early on. But I think you got to think long term with this, right? That's kind of what you were saying about thinking with the end in mind. Is that you got to say at some point I can't do all of these things.
Yeah.
But it's a dangerous place to be when you start thinking that way, because it's always harder to change.
Yeah, it is. I will tell you, for the longest time, I was guilty of that. But I've learned a lesson of late. Now Daniel does all my work, and will occasionally even make me a coffee. I don't think he's ever made me a coffee, but
see, I'm an employee, so I get burned out. I just quit, and he's stuck with it. So
Daniel's actually the manager. In probably most regards, I work for him. So
it's not true.
I own the joint, and he tells me what to do. I go, okay.
I don't even know where this is going, but we're going to get it back on track here. And so, obviously, and again, this is a little personal, we understand. You wearing too many hats may not be a good thing. And as Alan liked to call it when we came up with this slide, so the solutions to being cheap and stupid,
Right.
Not you, of course, we're calling somebody else stupid,
Right.
is, you have to really, make sure that you're not the jack of all trades and the master of none.
Right.
Find out what you're good at. I always work with our owners to say, what is your passion? Some people cannot sell, so they do the managing and the bookkeeping.
Right.
Other people can't stand to sit at a desk, and they're people, so they have to be out selling. Just find out what you're good at, because you can find qualified people to help you with the other areas. Here's another point. Are you working in or on your business? if you're blown out 8 to 7 every day, which I know, that's even more than 9-hour day. If you're blown out, just keeping track of all those things you're doing and you're never slowing down to work on your business, that's a mistake.
Yeah.
You got to do that. Good business owners have to do that. Here's a simple one. If you're not an expert, hire one.
Right.
Just hire somebody.
Right.
You know, and then here's the, you know, Alan brought this up about the bus, and the key there is, you know, to delegate and manage. So again, we realize that businesses aren't always at a place where they can have these big, robust staffs to do all these things they want to do, and sometimes you have to do these things.
Right.
All those things that we're talking about. But duplicating yourself and making sure there's duplication of efforts, that really helps you in times of when there's a crisis that does happen.
Right.
I mean, think about it, Alan. We're accountants, and over the last 5 tax seasons, which is our crucial time of year, we've had 2 of our staff members have had family catastrophes.
Right.
And we literally had to tell them, go deal with your family. It is the proper thing to do.
Right.
And guess what? We made it through.
Right.
But it was because of a team effort and duplication of effort. So don't think that this can't happen to you.
That's right. Daniel has a thing called ABC, always be coaching. And my final words on that are, there's an old, kind of almost like a joke in music retailing, that a lot of music retailers will say, well, what if I train someone and spend all that time and effort and they leave? And the real question is, what if you don't train them and they stay?
It's a good thought.
Thought you'd like that.
All right. Alan, are you ready for the riveting topic? They're seeing this on the slides and they're like, oh boy.
Now's my time to go take a coffee break.
Yes, but no, it's not.
Right.
And let's say one thing right up front, Alan.
Yeah.
We know we have viewers from all around the world,
Right.
Potentially viewing this, or so our egos think.
Yeah.
But what we don't practice international law. We're familiar with it a little bit, but we don't practice outside the United States.
That's right.
We have our own myriad of problems inside of the United States with this issue, and we've heard that other countries, states, people like that do.
Right.
So our first bit of advice would be, don't bury your head in the sand about this topic wherever you are, because we're going to kind of relate it a little bit to the United States consumers and the United States business owners.
Right.
But these topics we know are all over the place, right?
Right. I will tell you, one thing that's probably universal to everybody watching this video is that every country has its own tax enforcement agency. We have some clients that are from Japan, Canada, the UK, and so we know that there are audits of businesses to make sure they're paying their fair share of tax in those countries and probably all the other countries as well, in addition to the United States. So the simple point is just make sure that you comply with tax law. There's some additional issues of late that we've had to deal with here in the United States, ranging from labor laws to sales tax laws. Daniel's actually become like sort of our go-to guy on sales tax, and let me tell you how monumental that is. It's sales tax is governed by your states, so this dude has had to, this professional dude has had to learn or at least be able to research 50 different state laws as they relate to the collection of sales tax.
Yeah, sometimes they go to the county level.
Yes.
But we also know that sales tax, so let's talk about sales tax while you brought it, Alan, because that's kind of our first one, is in sales tax for those that may be watching elsewhere, it's the tax that's charged usually to the consumer on the purchase of goods or a service.
Right.
So it's something that you're collecting, ideally, with a sale, and then you remit it to your government. Well, that's pretty been around in the United States for a long time. But what's got complicated now is who you're remitting the money to, what charge.
And the channels under which sales tax are now having to be charged, because as I'm sure all of you are experiencing, there's been this migration from brick and mortar to online transactions, and so that has traditionally been a lot tougher to police for the states to track online sales and make sure that sales tax has been being collected and remitted. So that's a big issue these days.
Yeah, that's a tough one. Here's another one we see. This one kind of creeps up at inopportune times for our clients. All of a sudden they get a notice, well, you're not registered to do business here.
Right.
Well, what does that mean? You know, it's like, well, they forgot to file a piece of paper early on and pay a $25 fee, whatever it was.
Right,
But
right.
being registered to do business is a big thing, especially when you start, like for people like that don't register to do business in the United States.
Yes.
The United States gets involved, and
That's right.
you know they're a little less.
And there's high levels of tax withholding.
Yeah.
When you earn, when foreigners earn income here. So we have those kinds
That
of
one.
laws.
And then here's the other one, and again, we're assuming this is a problem for many other countries as well, is employment laws. Whether it's here in the United States, the hot topic lately has been independent contractor versus employee.
That's right.
But then you have, even within the employee, Alan, you have all these topics about what you can do, what you can't do, hiring practices,
Right.
firing practices.
Health insurance, or
all these.
employment benefits, all
Yeah.
those kinds of things.
And guys, before you email us and say, oh, I need some help with that, we're not the professional. There's usually not one professional that can take care of all these things for you. These are things where you have to have multiple professionals to make sure that with all of your employment laws, that's usually an employment attorney or an HR specialist.
Yep.
That's who would look at that. Registered to do business may be a corporate attorney, and then sales tax is going to be anywhere from internal to an accountant.
Correct.
So these are dangerous pitfalls, and if you're in the United States, especially if you're starting to sell across your state lines, you've got to watch out for sales tax.
That's right. So don't be afraid to hire professionals. And if you don't know who to hire, I got asked that question once when I was doing a presentation at NAM. How do I know if I've got a good accountant or a good lawyer? And I had to think about it for a second. I think the answer is talk to your friends, talk to other business owners, find out who they use and who they like and who they trust. That's always I think that's a good way to find a true professional.
Here's the top 5 we like, Alan. We always tell any of our new clients, make sure you have a good attorney, make sure you have a good accountant. We're hoping that's one of the two of us, but you never know.
Yeah.
An insurance agent. People are like, oh, I hate insurance agents because of whatever reason. I don't hate insurance agents. You don't either.
And no, it's just that we don't understand. It's a very complex segment of business.
It is.
You know,
But
you ever read an insurance policy?
No. No, they're lengthy, and
Right.
but they're important because if something should happen, that's
Right.
when you need them. So
Right.
you got to kind of balance that risk of not carrying insurance or different levels of insurance. So you need a good agent that you could come alongside
Yeah.
that can guide you on that. There's got to be trust there, right?
You took the words right out of my mouth. I was going to say, what's Daniel really talking about when you pick any one of these is that you have a fair amount of trust. in
Yeah,
those
we
people.
just talked about banking and having a rainy day
Yeah.
fund. You need a good banker and then a
Yeah.
payroll company. Look, if you don't know who to go to for this,
Right.
obviously talk to the professionals you know. You may have an accountant, you may have an attorney, you could ask for this. Obviously the VSA, the Violin Society of America, could be a resource. They may have some resources for you. If not, if you're a music merchant, that's what NAM stands for in case you didn't know, National Association of Music Merchants. When you're a member, they have resource pages for all of these different areas
Exactly.
to help you. A new one here in the States that we have a program called SCORE. It's by the Small Business Administration, where they'll partner you with an executive that used to be in business. Many times it's a CEO or CFO, and they'll just coach you. And guess what, Alan? It's free 99.
Love that.
Nothing.
Free is great.
Free is good. You get the help. So again, as you can see for us, what's most important is getting help to make sure you're compliant, and don't put your head in the sand on these issues of tax compliancy.
A lot of people, my final comment here is that a lot of people look at an attorney, an accountant, and those kinds of professionals, and they realize that they have to spend some money to hire those people. And so what I always like to say is just remember, it's really not an expense, it's an investment. You think they bought that?
Maybe.
Okay.
Alan, our last pitfall.
Yeah.
Succession planning. When do we start planning for a succession?
Well, a lot of people are thinking about it as they're taking their last breath and they're about to die.
Well, that's morbid. How about a little before that?
Yeah, exactly. It's always good to. You know what the general rule is? You start thinking about transition the day you open your business.
Yeah, but what's our number one call? Our number one call is somebody calls us and they said, "I'm had enough. I'm ready to get out of the music business."
Yes.
And guess what? They want to sell their business right then, right now.
Right. You have to plan for that.
Plan.
Yeah, because there's a time to sell. To the old buy low, sell high.
Yep.
Okay, that kind of thing. And then there's also getting ready to sell, and then the options of transitioning a business. Are you selling to a third party? Are you giving the business to the kids? Are you selling it to the kids? Are you selling it to a key employee? There's a lot of...
We have seen
Yeah.
so many options
Yeah.
over, so many succession paths, we'll call
Right.
it, happen over the last 5 years that people say, well, what's the typical path? Take the word typical out.
There
They
isn't
all look
any.
different.
Yeah, they all
They
do.
really do. They all look different. But the biggest thing, as Alan said there, is you got to plan on it from the beginning, because here's the pitfall we see, and this is the number one: something unexpected happens.
Right.
You know, Alan, you started off morbid, but it's reality.
You know, my favorite comment is, like, whenever we do succession planning or estate planning, a client will always say, you know, if I die, and I always get a chuckle about that because I don't think it's an if. I'm pretty sure it's not an if. I think it's a when. And nobody knows when. We don't know. It's a lot of this is in God's hands. And so something unexpected happens. That's not the time to start thinking about
No.
transitioning your business.
Or when we get the calls and say something did happen, now what do I do with the business?
Right. And then you're leaving it to your family to figure it out.
Yeah,
and
it's
and
tough.
that's horrible. You don't want to do that to your family. They may not have the knowledge base that you had about the business, and you know, you're asking them to figure out what to do with your business at a time that they're grieving.
Yeah.
So
Yeah. Alan, the second one is you missed a sweet deal. This kind of goes back to wearing too many hats.
right.
And I got to tell you, I've been here with you about 5 years, and I had a client that called, and they asked me to do a little evaluation of their business, what I thought it was worth.
Right.
And I'm just going to use hypothetical numbers here. And I got done, and I said, okay, I think your business is worth $250,000. And the owner said, well, that's about what the person wants to offer me for. And I was like, okay, at least we're in the same ballpark.
Yeah.
They said to me, would you believe me if I told you that about 5 years prior to that, they were offered $1.2 million for their business?
Yeah.
It was literally like 5 times
Yeah.
what they were doing now. They missed the sweet deal.
That's right.
And they told me, and this is the way they feel, back when they were offered $1.2 million in that example, they probably thought it was worth $2 million.
Right.
And so understanding what you're worth and the value of your business,
Yeah.
so when somebody comes in and offers you the money, you know, and you're ready to
That's
go.
right.
You know, because if not, then again, we go back, the unexpected, leaving it to the family, it's a tough place to be.
Exactly. I laugh and missed the sweet deal. What they missed was the sweet ignorance. The party offering 1.2 million was probably, and we've seen that.
We've seen it.
We have seen, you know, amounts paid for businesses that were paid far greater than arguably what the business was worth. That's because the buyer lacked some important knowledge about how businesses are valued and things of that nature. But
so, and Alan, again, not trying to solicit business or anything like that, but if you go back, there's resources on the NAM webpage
Yes.
where we've done sessions on
Yes.
succession planning.
this has become the new hot topic. You know why, Daniel? Us guys my age, we're baby boomers. Guess what? We're entering the
Retirement.
phase of retirement. So all of a sudden, the last 4 or 5 years, boom, you know, inventory management which was always the hot topic, has become still important. But all of a sudden, it's been succession. How do I transition my business?
Yeah,
So-
and even in this pandemic, people are still trying to sell, and people are buying
yeah,
businesses.
that's right.
So
So there's opportunities.
you never
out
know
there.
when the sweet
Right,
deal's going to
right,
be
right.
there. Do it now.
Right,
If you're going to do an internal succession, one of your kids, a manager,
right.
start grooming them.
Start
You know, the
training.
whole thought, like, you know, Alan said earlier, like, if I train somebody, they may leave. But what happens if you don't train them? It was a
That's
great
right.
point. The same point here is, well, if you don't start imparting your knowledge on them and
Right.
showing them the financials and how to run a business,
Right.
how are they going to know how to do it?
And one way that they can prove to you that they can run the business is, guess what? Let them run the business while you take a 2-week vacation and see how they do.
Yeah.
You know, when they're forced to do it.
Exactly. If there's no heir apparent, start planning to sell it. Selling the business. We have a good friend that does some business transactions and
Right.
what they call mergers and acquisitions. And they always say, give me 2 to 3 years
Right.
to get in there and really work with the business and position it. You're not doing anything wrong, or it's not like you're doing anything schemy, but it's
Yeah.
like you're really cleaning up house.
That's right.
I mean, think about it. If you're going to put your house on the market, usually you paint, you do all this
Yeah.
stuff. Same thing with the business.
I'm thinking of a particular client that we had that all of a sudden started entering some very profitable years. I mean, he was approaching retirement age, and he started asking us, is now a good time to sell? And I said, you know what, we can see bigger profitability coming down the road in a few years. Wait a few years. He did, and he got top dollar for that business.
Yeah.
So,
It's amazing if you have a chance to plan it and just look and see how you're building the
Right.
business. It goes back to Alan's statement. when you enter the business, if you're going to go buy one, if you're in a business, you should already have a 5 to 10 year plan and kind of know what you're worth
Right.
in case that person walks in. Because, and again, we talk about tax planning. This last point here is about tax planning.
Right.
There's ways in the United States to avoid some taxes on that.
Right.
So that's something where you got to collaborate with those professionals.
Exactly.
You need your team. So you got to have your team in order. So Alan,
Good
these have been 5 things that we talked about, just, we call them pitfalls,
Yes.
but I also call them areas of opportunity.
Correct.
Because it's about how you think. And even as you're finishing up this session right now, we appreciate you being with us. We hope it's been good for you. But if you just watched it and you close your computer and say, okay, now I got to go place an order, they don't understand what we got to do. We do understand, because when we're done shooting this video,
Right.
we're going to go back to preparing taxes. So we get it. But if you didn't write something down and if you don't take action, because as it says here, action changes things.
Right.
If you just listen to this and don't take action, nothing's going to change.
That's right. And we're not sitting here professing to have just given you all the answers to those topics, over the course of a half hour, let's just say. But it should cause you to think and to consider whether these problems are affecting you. And then there's myriad of resources out on the internet, on our website, articles that you can read more about how to resolve some of those issues and really fix those things to assure yourself a good transition, manage your inventory, have the right kind of debt, those kinds of things. So
Yeah, and just again, we're not trying to solicit here, but if you want some of those resources, they are free on our website. It's www.fkco.com.
that's right.
And under resources, you can find different presentations and different things that would be helpful to you.
Exactly.
So we hope this was helpful for you.
Yeah, we
And-
love doing this.
Yeah, when sorry we couldn't interact. We heard you laughing at the jokes here, and so that was good.
In our heads.
And we look forward to talking with you next time.
Sounds great. Stay healthy. We'll see you everybody sometime soon.